Welcome to the Explainer. Okay, today we're going to demystify some accounting standards that, let's be honest, can usually make people's eyes glaze over. We are taking all that dense regulatory text from Aspe 3400 and 3290 and translating it into a practical, easy-to-use playbook for private enterprises. We'll be navigating the official guidance on revenue and contingencies, but we're going to look at them on a spectrum, starting from absolute rock-solid certainty all the way to complete unpredictability. I want you to picture your own business for a second. Let's say you just landed a massive, multi-year contract. How do you handle the excitement of that expected cash inflow on your books before you've even picked up a single tool or delivered a single service? And then, flipping the script, how do you account for something like a sudden, totally unexpected lawsuit that might drain your resources? It's all about balancing those expected inflows against the nasty surprises, and as we're going to see, the accounting rules draw some incredibly specific boundaries for both. All right, here's our roadmap for today. 1. The certainty of revenue. 2. Tackling complex contracts. 3. Are you principal or agent? 4. Navigating contingent losses. And 5. The rule for contingent gains. Let's kick things off with Section 1, the certainty of revenue. Starting on the certain end of our spectrum with Section 3400. Revenue is basically the inflow of cash or receivables that comes from your ordinary day-to-day activities. But here's the catch. You can't just record it whenever you feel like it. The absolutely crucial point here is that you can only recognize revenue when performance is actually achieved. If you're selling goods, that literally means you've transferred the significant risks and rewards of ownership right over to the buyer. Think about it. If the buyer can return the product for a full refund for no good reason, or if you're still managing the goods in your warehouse, well, you haven't really transferred that risk yet, have you? Now, what happens when things get a little complicated? Often, a single contract isn't just one simple thing. Say you're selling a software license, but you're also throwing in the installation and a full year of training. You've got to ask yourself, does this arrangement have separately identifiable deliverables? If those different pieces have value to the customer on a standalone basis, you literally have to carve the contract up. You allocate the total revenue to each specific piece based on its standalone selling price. It's kind of like breaking down a giant combo meal into its individual menu items. Once you've identified those separate units, how do you actually recognize the revenue for each one? Well, you have to choose your path. Is this a straightforward transaction for the sale of goods, or is it a service transaction, or maybe a long-term contract? If it's just a simple sale of goods, you use the standard recognition rules. Basically, you record it when the goods are delivered. But if the performance takes more than a single act over time, you get pushed into a completely different set of rules. Which brings us right into Section 2, tackling complex contracts. Imagine you're building a massive 500-meter bridge over a 3-year timeline, or coding a huge piece of custom software. Performance on these things doesn't just happen all at once. If you can reasonably estimate your progress on these massive projects, the standard says you use the percentage of completion method. It's a really systematic approach. Step 1, you estimate your total costs. Step 2, you measure your progress. You might use input measures, like comparing the labor hours you've spent so far to the total estimated hours, or you might use output measures, like the actual number of miles of highway you've managed to pave. Then, step 3, you recognize a proportional amount of the total contract revenue based on that exact percentage of work you've accomplished. But what if your estimates are just a total mess? Listen, if your progress is simply too murky to measure accurately, you cannot use the percentage of completion method. No way. Instead, you're forced to use the completed contract method, and this means you've got to wait. You recognize zero revenue until the entire contract is completed, or at least substantially completed. It's a super conservative approach, but it ensures you don't accidentally overstate your earnings. Okay, pay close attention here because this is a surprising and absolutely vital rule. What happens if you're halfway through building that bridge and suddenly the cost of steel skyrockets? You realize the whole project is ultimately going to lose money. Do you wait it out? Nope. Even if you're only 20% done with the project, if your estimates show a probable overall loss, you must take the entire hit to your income statement immediately. Accounting rules are specifically designed to recognize bad news the very second it becomes probable. Moving right along to Section 3, are you principal or agent? So we've covered making things and building things, but what if your business is essentially acting as a middleman, like an online marketplace or a broker matching buyers with suppliers? You face a really common pitfall here. Do you report the gross amount billed to a customer, or just the net commission that you keep? Well, if you're the primary obligor, meaning it's on you to fulfill the order, and you hold the inventory risk, and you can set the prices, you're acting as a principal. you record the gross revenue. But if a third-party supplier is the one fulfilling the order, and you just earn a fixed fee or commission without taking on inventory or credit risk, you're merely an agent. In that case, you only record your net fee as revenue. Getting this wrong can artificially inflate your top-line numbers, and trust me, regulators are definitely watching out for that. All right, shifting gears to Section 4, Navigating Contingent Losses. We are officially transitioning away from revenue now, crossing over the spectrum into the murky waters of extreme uncertainty. What if your business suddenly gets sued, or a major customer threatens to expropriate your assets? Notice the phrase existing condition in the definition here. A contingency is all about an underlying situation that exists right now, today, at the date of your financial statements. But the ultimate financial impact? That depends completely on some unpredictable future outcome, like a judge's ruling in a court case next year. To figure out how to account for this underlying risk, you literally have to translate the uncertainty into one of 3 specific probability buckets. Is the future event likely, meaning the chance of it happening is high? Is it unlikely, meaning the chance is slight? Or is it simply not determinable, meaning you just don't have a crystal ball and cannot make a reasonable guess either way? Once you've picked your bucket, here's the rule of thumb. You only accrue a loss, meaning you actually take the hit to your income statement and record a liability on your balance sheet, if the loss is both likely and you can reasonably estimate the dollar amount. If the loss is likely but the amount is just impossible to calculate, or if the whole outcome is not determinable, you don't touch the income statement. Instead, you just disclose the existence of the risk in the text notes of your financial statements, so at least the readers are warned. Here's a fun fact that actually trips a lot of business owners up. People often think that not having insurance is a contingent loss, but the standard specifically points out that a lack of insurance against risks like fires or explosions is not a contingency. Why? Because the peril is entirely random. An unpredictable fire hasn't actually happened yet, meaning no asset is currently impaired. There is no existing condition right now, so you don't accrue a loss for a disaster that literally hasn't taken place. And finally, Section 5, the rule for contingent gains. Let's explore the absolute extreme edge of our certainty spectrum. What happens when the uncertainty is actually in your favor? Say you expect a sudden windfall, or you're the one suing someone else and you're expecting a massive, favorable settlement. Well, as we just learned, if a contingent loss is likely and estimable, you have to accrue it immediately. But contingent gains, you never accrue them in the financial statements, period. No matter what. Even if you're 99% sure you're going to win that lawsuit, you cannot record the gain on your income statement until it is fully realized. So why are they so strict about this? It all comes down to fiercely protecting the integrity of the financial statements. The underlying philosophy of accounting is conservatism. If you accrue a contingent gain, you're recognizing revenue that might actually never materialize if that final court decision goes sideways. The rules ensure that investors and lenders are never misled by premature celebrations or, wishful thinking. Now, actually, scratch that. You don't have to keep it a total secret. You can still let the readers of your financial statements know about the potential upside by adding a disclosure in the notes. But the standard warns that you have to exercise extreme care here. You're only allowed to disclose a contingent gain in the notes if it's deemed likely to occur. If it's unlikely, you can't even mention it, which prevents any misleading implications about your future wealth. So think about it. When you look at your own books, are you accurately capturing your economic reality, or are you letting uncertainty blur the lines? Keep this certainty spectrum in mind as you review your business's expected inflows and unexpected surprises. Are you properly transferring risks before you recognize revenue? Are you taking your losses early but waiting patiently for your gains? Mastering these principles is absolutely crucial to ensuring your financial statements tell the true, unblurred story of your business. Thanks for joining me on this explainer, and I hope this helps you navigate the fascinating structure behind the numbers.